Is the microphone working? Yes, great. Okay. Well, thank you very much indeed. Well, we just had a fascinating afternoon of conversation. And this is the last panel, the highlight, with three luminaries from the financial world who need no introduction. Clare, Woodman at the end from Morgan Stanley, Axel Weber, now at UBS, formerly Bundesbank, and Mark Carney from the Bank of England. And we're here today to talk about the future of financial cooperation, future financial architecture. We're here to celebrate a 75th birthday. And frankly, under many measures, it's quite an unhappy birthday because although the IMF and World Bank are still performing the functions with great enthusiasm, although we do have institutions like the Financial Stability Board and other institutions for financial cooperation, we're living in a world which is increasingly protectionist. We're living in a world of increasing unilateral action. I'm not going to mention Brexit yet, but we've just heard from Secretary Mnuchin about all the things he's doing in terms of the US-China trade talks, including a currency agreement, which is hardly a display of multilateralism. And we're living in a time when many of the populations are questioning what these institutions and this collaboration is for. The financial community responded with tremendous cooperation to the financial crisis. There was good reactive collaboration, but whether there's been good proactive collaboration is a big question. So, Mark.
Okay.
I'm being British and very informal. Yeah. Sorry, Governor Carney, to be American.
Actually, it's the other way around, actually. Yeah.
Wow.
But
is multilateralism dead?
No, it's not dead. And thanks for your admirable restraint on Brexit. We'll see how long that lasts. But
I should say about 7 minutes.
About 7 minutes, okay.
Yeah.
Why don't I do this, which is just say a few words about how the FSB has worked, because I think it has worked, and then maybe flag a couple of issues that are on, coming issues that might challenge the model, but equally are suited to the model. So let's just take it as, if we can, I mean, people will have issues with various individual reforms, but let's just take it as a lot has been done, has been agreed that has made the system stronger, safer, and fairer. More can be done, that not everything's perfect, it doesn't all work, but there has been a process that has developed a fairly coherent and comprehensive set of reforms. So why was that the case? Now, it wasn't done, these agreements were not made in a treaty-based organization, so it's outside of the formal Bretton Woods structure. It had the advantage, admittedly, it had the advantage up front of having a crisis, which is always a good catalyst, and a reasonably quick diagnosis of some of the underlying causes of that crisis, not the deep economic causes, but in the financial sector. So there were issues to address. It also had the advantage right up front of having a very clear mandate from G20 leaders, and through the G20 summit cycle, a way to catalyze action and to assess progress. The next advantage the FSB has had is it's had the right people around the table. And by that I mean it's not just, and I used to be one of these people, it's not just international Sherpas who go to IMF meetings and G20 meetings and various other meetings of the Bretton Woods Committee. Glad to be here. But that's basically what they do, is they fly around the world and go to meetings as opposed to also do a day job. And it's quite,
like Clare. Clare does a day job.
Clare does a day job. You do a day job. Actually, I'm looking across this room. All of you do day jobs. But there are another group of people who aren't in this room who are just flying around. But the point being, so if you bring the bank regulator from one of the G20 countries to a discussion about how we should develop a resolution framework for banks, he or she knows that they're going to have to go back and implement this. They know a lot about how banks actually work. They know about their home regulatory structure. It is not about assembling a series of words, it's about actually solving a problem. And so you get the right people in the room, the regulators, central banks, the finance ministries for the political backing, the international standard setters, and you have a process which actually, and this is the key, you have to listen to the people in the room, and it can be messy, and you have to develop a consensus over time. But if I can give very quickly a couple examples, on Too Big to Fail, the actual structure of that was ultimately heavily influenced by China. Because of some of the ideas that came out. The design of the international liquidity standards by Mexico, because they saw certain aspects in terms of foreign banks operating in Mexico. So again, you get a better process. And that process creates a sense of ownership. And since it's the people who actually run the organizations back home, when they go home to implement, now, there's always going to be some tailoring, and you have to accept that there'll be some tailoring of these reforms. By and large, they're implemented.
Right.
If they're not, it's assessed and looked at. So I just wanted to, why it worked. It's not treaty-based. You have a process that gets there. Now, the challenge, excuse me, the challenge on a go-forward basis is there's less immediate consensus on what the issues are, because you're not fighting a crisis. You're addressing counterfactuals, risks that could come, whether it's around asset management, issues around transition to a low-carbon economy. And then I'll finish with this, because I can see you want to move on. But the to Brexit.
Not yet.
So actually, I'm going to stretch this out now. On a series of issues around, let's call it operational risk.
Yeah.
So one of the big, there's a bunch of people from the private sector, private financial sector here. Clare would know this, live this. A shift of activities to the cloud. Okay, that is a fundamental cross-border issue. It has an issue in terms of standards, supervisory cooperation, understanding those issues. This is a coming issue that we need to address.
Yeah.
Cyber is fundamentally cross-border and requires heavy elements of cooperation. Those issues also require the financial sector and financial regulators to talk to other regulators, because they're common issues. Unlike much of what's in finance that was dealt with after the crisis, these are issues that cut across a huge range of industries.
Yeah.
Now, the cloud, in cyber, the financial sector is attacked much more than any other sector in the economy. The systemic consequences are arguably greater. But the solution on cyber is a broader solution. So those aspects bring new challenges. I do think this sort of architecture will continue to be relevant, and that what's crucial, and I'll finish on this, is, and I think there is real progress on this, particularly with the fund, is integrating that with the Bretton Woods, the historic Bretton Woods institutions. So when you think about implementation of FSB reforms, and potential adjustment of those reforms when they're not working perfectly together, when they're not working perfectly together. The fund's FSAP review programs are critical. And then the last thing, I'd be remiss if I didn't mention it, because Tharman is here, and this is one part of a great set of work that he did on the future of the system, but how surveillance is conducted and how joined up surveillance is between the authorities on the ground, the fund, and I think the FSB-IMF nexus is crucial for that.
Absolutely.
Stop there.
Axel, would you agree? I mean, Marcus just argued that essentially, the FSB has been one example of collaboration working, but that was because they had the right people and they were responding to a crisis.
Yes,
What about the next phase?
I don't have that much different view. If you look at the Bretton Woods organizations, really, when we hit the financial crisis, it was a global crisis. You needed coordination at the center. And of course, at the center of that crisis coordination mechanism was not just the various central banks and financial institutions, it was also the IMF. Best thing that can happen to you, an experienced 65-year-old institution that knows it all is at the helm of crisis management. And I think in the post-crisis resolution area, it also played an important role. But we've moved on. Being a Swiss bank, we know how important, in addition to Bretton Woods, organizations based in Washington, D.C., Basel-based organizations are. Whether it's the FSB, whether it's the Basel Committee, whether it's the IOSCO, There is a lot of work in terms of re-regulating the system and making the transition from crisis management to post-crisis stability enhancing collaboration that was much more based on collaboration of informal bodies. Actually, the elevation of the FSB was one such coordinated move, and I think it worked well. If I look at what is the day-to-day for us as a banking industry, I would say largely when it comes to capital, when it comes to liquidity, when it comes to resolvability, we're seeing the end of the tunnel there because that work is largely done. Over the last 10 years, we've massively improved the resilience of the financial institutions we're in charge of. Have we improved it in every area? No, it's capital, liquidity, resolvability. But if you look at operations, and Mark mentioned that, operational risks, there is a whole new area of collaboration that we need to work. And when I look at who do we work with here, I also have the privilege of sharing the IAF, which is the Global Industry Organization, also a Washington-based institution. But when we talk about cyber resilience, about AML, KYC, about financial crime, we actually talk to Europol, we talk to international law enforcement agencies, and the entire sector that is around that. So it's law enforcement, it is organizations like Europol or Interpol, it is actually Homeland Security and many of the cyber defense institutions that are being built. Naturally, we don't have those. In Switzerland, we had to build a cyber resilience center and a cyber resilience organization that didn't exist before. So when it comes to stability in the financial sector, given that we are a digital industry, given that digitalization is changing the way the industry works, given the interconnection between client is moving on to platforms, given that we have problems in making sure that financial stability is also there in terms of operational resilience, we work with different players and need to work with different players to get that going. So that's one part where I think the whole infrastructure is moving from Basel-based organizations and Washington-based organizations to organizations that have a much less established way of collaborating. And actually, it's very hard to get all these law enforcement agencies around the table because exchange of information, the ability of us to exchange information with non-domestic law enforcement agencies is very limited, and we need the coordination by those organizations. Big work that is ahead of us, but we need to get it done because cyber resilience and operational resilience is key for making sure in a digitalized financial world we have clients be able to address their needs for transactions in each and every state of the world. Move one step beyond, and I'm finishing on that. Look at the future of banking. The future of banking is going to be about new assets, about new investments. And let me just mention two areas where we're very active. One is sustainable investments, a whole new asset class. At the moment, there is no clear rules around that. We work with the United Nations and other organizations to really establish standards so that we can prevent that there is mis-selling under that label from the start. Because that industry needs to have a credible start. If it is misused and if there's mis-selling, if there's greenwashing, it will not get the traction it needs. One element of that, impact investing. Again, we're working with organizations like the IFC, and we launch a set of principles for industry principles, voluntary agreements about some of these impact investment universe and how that can develop. So as you're looking at how the financial world is developing, we're moving more and more from Washington and Basel-based organizations to collaborations that don't have constituency, but where you need the collaboration of institutions in an evolving space. And my view is look, the first organization that is up there and gets on top of an issue, they're out there to organize that in the future. And that, for example, if you look at the United Nations attempt with the Sustainable Development Goals, at the moment, the entire workflow of that is under that heading. And there'll be more organizations developing as we move from planning and understanding the problem to implementing and getting it done. Implementation needs different collaboration than actually the drawing of a bid plan and raising awareness. We're at the stage, let's sit down and get it done. And getting it done requires collaboration with other organizations. Doesn't mean you don't need to work anymore with the Basel or Washington-based institutions. That's a given. You need to continue to do that. But there'll be other players in that game that we need to bring onto the same level of international collaboration. The worst thing you would get, and this would be my last point, the worst thing you get is fragmentation, and we start from not level playing field in any of these areas. We should learn the lesson from the crisis that basically the best thing on these global topics is to start at the global level with a global reach and a global level playing field, because then we avoid having to deal with problems of arbitrage, with problem of regulatory differentials, because that's usually a recipe for disaster. But we're not there.
So we're basically dealing with quite a fundamental shift in the tribes, or new tribes. I mean, Clare, when you look at the regulatory architecture, when you look at the mechanisms for coordination, do you feel confident that they are sufficiently cohesive and clear-cut, or are you drowning in competing tribal groups and structures?
Well, obviously, being in a regulated industry and having, a number of regulators and a primary regulator to satisfy and work with, obviously there's always going to be nuance in the requirements and the expectations. But this morning we had a large session roundtable at the CFTC to talk about benchmark reform. And that's one initiative that in the last year, I think we have made more progress working through a combination of public and private sector together that I don't think anyone would have expected. Now, that's not to say that between now and 2021, there is considerable work to do to implement alternative reference rates and get those fully implemented and used. The new LIBOR, correct. But there's a real live example of where new structures and new constituencies are working well together to reform and improve the marketplace. I would say, just to add to Axel and Mark's comments, technology absolutely is changing the way that we do business. The wholesale markets are, pretty much fully electronified. And so, of course, the top risk that every management team, board and regulator and central bank worries about is cyber risk. We ourselves at Morgan Stanley, probably about 5 years ago, were spending something like less than $100 million on cyber risk. And this year, I suspect we'll spend, somewhere around $400 million on cyber. And to talk about collective solutions, that's one area where each firm can build up its responses and its protective defences to protect its perimeter, but we absolutely need to take forward and make sure that there are collaborative and collective efforts to ensure that the industry is protected. So some of the work, for example, that the Governor was referring to in terms of operational resiliency is a key priority for us in the coming year. And we absolutely welcome what the FSB and the Bank of England have been promoting. I think the other thing that I think Axel sort of touched on, that I think the financial architecture really needs to focus on, is if we look at markets, they are evolving in structure in terms of electronification, but the nature of markets are also changing. And what we have seen in the last few years is the expansion and growth of private markets as a really meaningful place for small and large companies to find financing and for investors to find alternative sources of yield. And so I think that as the architecture looks forward, certainly regulators and policymakers will be thinking about, have they made the right conclusions about whether private markets might be potentially a source of future financial instability or not. Climate change obviously is a key priority, and the role that finance plays not only to combat climate change but also to provide sustainable investing opportunities is key. And like UBS, we have been heavily involved in raising finance for green and sustainable bonds, and have a very key goal to make sure that we finance 250 billion of low carbon initiatives by 2030.
Wow.
But last and not least, one of the lessons from the crisis that is continuing and we need to be focused on, and it's been a key part of the way that we have repositioned our business and our model, is the continued focus on culture and conduct. And earlier on in the sessions today, one of the audience, I think from Transparency International, raised governance, and I think corporate governance is absolutely front and foremost at people's minds in terms of continuity of issues to focus on.
Thank you. Can I ask one question, which is somewhat the elephant in the room, which is that, you know, Bretton Woods was created at a time when there were essentially the victors from World War II were in charge. We now have a world where China is increasingly powerful, and yet if you look at the IMF's Global Financial Stability Report, which I just read a few hours ago, you know, the part of the chart in terms of financial risks that's flashing red is China. And also the non-banking sector to a degree, to pick up on Clare's point. How easy is it going to be in the coming years to actually ensure that China is a meaningful and active part of any system of global collaboration?
Well,
I mean, you know, how do you say Bretton Woods in Chinese?
Well, first off, China is absolutely central to every collaborative mechanism. I mean, front and center in the G20, at the Bretton Woods institutions themselves. I gave an example of some of the key reforms, but it's true virtually every reform. China is an extremely active participant in the FSB, and I would go further to say that actually some elements of the approach that they're taking to address issues in shadow banking sector, have been informed by FSB reviews and conversations and engagement with partners.
They read your reports.
No, much more than that. Don't be glib about it. This is,
I'm sorry.
you asked a serious question.
Yeah.
They are fully engaged in these issues, and these are serious issues, but they are the product in part of success. I mean, it is very hard to emerge without having some form. I mean, when you go through a rapid period of financial deepening, it's very easy to get off track on that. You have to be very nimble, and I think what we're seeing is the Chinese are taking the lessons that globally, and they're taking best practice and starting to apply it. Now, they have an issue. They'll fully admit that they have an issue. They know that, and it's one of the reasons why that economy is slowed. But I would say that their chances of success are greatly enhanced by the fact that they are, fully engaged members of the system.
Right. Clare and Axel, I'd like to ask you, I mean, either feel free to comment on China if you like, but I'm also curious, when you look at where the world is today in terms of financial stability, how confident are you that we are in a much better place than before?
I think one aspect that Clare has already alluded to is, I think we have made the core of the financial system, deposit-taking institutions, pretty much safer than they were. I'm much less worried about that core part of the financial system, as most of the regulators will also tell you. But what we're not sure is whether market-based finance, and if the next crisis is not like the last crisis, whether we have sufficient provisions for stability and liquidity provision in a crisis in that part of the system. And I think it is largely limited by factors like central bank refinancing access is there for banks. It's not there for a broader set of players. And in the last financial crisis, they weren't the core of the problem. But I can tell you in Europe, access of funds in the market to central bank liquidity was done by opening emergency windows in three-party repos where, thankfully enough, most of them had a parent that was a bank. And so they could get collateral lending through the bank to the market-based institution, so they didn't have to close and sell down assets. It's not sure, since that parent model has disappeared by and large, whether market-based finance will have the same access to liquidity. And actually, what banks are doing is we're not engaging in market making anymore to the same degree as in the past. We're basically having liquidity buffers that, in case there is a crisis, we rely on our emergency liquidity and we stop lending. And so market players have to access liquidity through other forms and means. And of course, they will turn to the central banks and they will tell you it's not within our framework. So I think we have to put some provisions in.
Within our framework.
It's in with your framework.
It's in the Bank of England.
You're an absolute exception, a very laudable exception. And when we talk about many other central banks, really feel that constructive ambiguity around that issue rather than constructive clarity is a way to go. I think that's not true. And the second point that I would like to make is, look at the way collaboration has evolved. If you start Bretton Woods organizations, I've been a governor on the fund for Germany for a while. We have failed to open up fast enough to the emergence of China. We've not involved China and given them enough seat and voice around the table as fast enough as it might have been necessary. If you look at the development area, they started their own model with their own organizations, and they're looking at the Asian Pacific region as a sphere of influence, and they're using their financial resources in that area to gain access and to basically have good collaboration and to provide financing. The reaction to that has to be that we have to bring them back into the Washington-based organizations. We need to work together. Not doing that would be very, very difficult, because if they go off in one direction and we go off another, it doesn't make for a stable future. So I think even in areas where we've been slow, and because we were slow, because the financial crisis hit, everyone was looking at their financial system, we had other things to do than really to open up and change the architecture at the same time where we were relying on the architecture to play a key role in crisis management. And China admittedly wasn't hit hard by the financial crisis, but in the post-crisis world, we haven't opened up enough. And I think now what you're seeing, and that gets me somewhat concerned, is a bipolar world emerging. Discussions between the United States and China on currency arrangements, on the opening up of financial markets, on liberalization of the capital accounts. That has become a very bilateral discussion among the two major currencies in the world, that is the renminbi and the US. And we somehow have to bring that back into the negotiating framework of the multilateral organizations, else we have bilateralism and a web of bilateral arrangements evolve, which in my view is in nobody's interest.
But in practical terms, that's going to be extraordinarily difficult. I mean, I must say, when I look at what's happening right now in terms of the fragmentation of the system, I'm wondering, is there going to actually be a Bretton Woods institutional framework in 75 years' time or 7 years' time?
There should be. But, I agree with you that there are challenges, but we need to rise to those challenges. What is very important is that these international organizations have played a key role and can continue to play a key role, but they need to adapt. If they don't adapt fast enough, new organizations will basically emerge on the perimeters. And so it's not a given that they will not keep the relevance they had over 75 years. But in order to play that role in the future, you need much stronger adaptation to the new challenges, and you need everyone to look to the IMF and the World Bank for resolution rather than looking somewhere else to solve these problems. And I think it is important that the heads of these organizations understand that and act on that. And I think they do. It's just very hard, once these discussions have started, to bring everyone back to the table.
Right.
If
Mark,
I
and then
could
Clare.
make a point, just picking up on where Axel left off, which is that, so over the course of the next few decades, and it's hard to predict with certainty how this adjustment goes, but there's going to be a gradual reordering of the reserve currency system, the actual reserve currency, not talking about nominal shares of an SDR. During that period of time, the fundamental asymmetry that exists in the international monetary and financial system is only going to grow. By which I mean that the weight of the emerging world, including China, will continue to increase, but the dominance of the dollar in trade invoicing, in financial flows, in financial assets will remain disproportionate relative to, there's huge incumbency value and we know this from the UK's own experience a century ago. And in that world, and in a world of relatively free capital flows, a lot of attention has to be paid to the underlying financial architecture. It starts partly with the underlying safety nets, but issues such as Axel alluded to on let's say, the asset management complex, how that grows, the potential flows, the issues Clare brought up in terms of electronification of markets, the way that cross-border retail payments and corporate payments are made as fintech spreads out. All of those have to be managed in a way that takes into account, in a way that is increases the quantum of sustainable capital flows, or to put it in IMF speak, reduces the capital flows at risk in the system, because there'll be a lot of pressure from the center. And just I'll finish with just one basic point, which this room kind of knows, but it bears repeating, which is, You know, the last time the Fed raised interest rates, the emerging world was about a little more than 40% of the global economy. Now it's 60% of the global economy. The spillover, spill back is bigger. And last time, in the intervening period between those two rate cycles, all the net flows to emerging economies have been through market-based finance, not through the banking system. That's a different world, both in the real economy and also in the structure of finance. And that's why, I mean, I'm not answering your question in terms of who's going to do it, but between a combination of, you know, the private sector, but very importantly, I think the FSB and the IMF, that it needs to work together, and obviously with the big players themselves. But these issues are too global to be solved on a bilateral basis.
But for a bank like Morgan Stanley, I mean, you must be confronting a future that's so uncertain that in a sense you have to build in a lot of optionality into your structure in terms of how you actually run your business.
Well, we had multiple scenarios for Brexit, but probably not the one that we're currently facing this week.
I am going to ask Mark about Brexit in a moment, but do tell us about your scenarios on Brexit. Did you give it a probability?
No, we don't assign a probabilities because I don't think a decision tree will work for this this situation. You definitely need to have lots of scenarios, and a plan for the worst and hope for the best was probably the right strategy to take. So let's just say that. I would just say one of the other consequences of all the regulatory reform that I think we all just, as a practitioner, just take for granted now, but we are doing, is management teams are much more forward-looking in their approach. They are using a lot more data. There is a lot more data available, but much more forward-looking in the approach to risk management. If I think about my risk management team in London, it's grown tenfold over the last 5 years. And so I think every organisation, large banks, small banks, are all taking a very different approach to how do they plan and think about forward-looking scenarios. And so I think we take some of that for granted because we just think the reg reform process, it worked, we're all fixed, it's okay, now what's the next phase? But we have definitely taken some really good working practices with us, and I think they help you to deal with the uncertainty that you're asking about.
So what is your central scenario for Brexit now, and can you cope with a no-deal Brexit?
Well, we are coping with potentially the risk of a no-deal Brexit, but I believe that the EU leaders are all still having dinner, and so we might learn something new when we finish this session. But nobody certainly would want to trust a crystal ball or assign probabilities. Most firms just made sure that they were ready to serve their clients on the date, which may be moving and is constantly moving, to ensure that we could operate in multiple jurisdictions.
Mark, I have to ask you this, and I have waited for 25 minutes. If you're a betting man, what do you think is going to happen next? And how concerned are you about the danger of either a short-term financial market shock as a result of these multiple scenarios, as Clare says, or a long-term erosion of the city's position?
Okay. A couple points, if I may. One of the things, and I think Clare's point about forward-looking risk management, planning for the worst, of hoping for the best, it's much more than words in these situations.
Yeah.
And it really is, and this is an attitudinal change that's, I think, at the core of finance, which is, okay, plan for failure, plan for something going wrong. That holds for cyber. So one of the things we look, I'll get back to Brexit in a second, but one of the things we look at for cyber is, okay, lots of work on defenses, but actually the test we're doing now of our industry, core of the industry, is, okay, assume your system goes down, what are you going to do? How are you going to recover? Which is a bit akin to ending too big to fail. The question is, okay, just assume the bank, it doesn't matter what the reason is, somebody at some point will be holed below the waterline, so to speak, and the question is, how are they resolved? And how does the big global institution recover in a way that allows the system to continue on, and how does the big global institution fail in a way that allows the system as a whole to continue on? Those are the types of questions you answer. And so from a Brexit perspective, you assume, shock, no deal. And then the question is, what could happen and how should the system organize itself? And look, we have been saying this, and in the full knowledge that it could actually be tested, that the core of the financial system is ready for Brexit, in the sense of it has built up capital, it's built up liquidity. The firms are doing it themselves, but we're actually getting the data as well. On daily liquidity monitoring, the core of the system in the UK is over £1 trillion sterling of liquidity. They have access to more than 300 billion on top of that in all major currencies from the Bank of England if they were to need it. That actually goes for some of the asset managers to Axel's point, if they were to need it. It's not clear why they would, but if that's, again, you assume that they might, and then put yourself in a position in order to do that. A series of the big plumbing issues, and I know you know all this stuff, and there's not enough time to go into them, but have been taken off the table. So clear derivatives, a range of other issues, and we're in close contact with the European authorities around any residual issues, and particularly about, of course, the famous unknown unknowns that can happen if you have a very complicated system that has a shock. Now, there is a distinction between financial stability and market stability, and financial stability and economic stability. And if you have an economic shock, markets are going to adjust, and those adjustments could be quite substantial. But I think the test of Brexit, and you have to take my word for it at the moment, and it may not actually be tested, but has shown a big shift that has happened in the private sector, and I'd like to say in the public sector as well, is how you manage risk. Let me put it to a fine point, and a number of people here in the room lived through this, as did I. It bears no resemblance to Lehman in terms of the degree of preparation. Lehman was, yeah, it'll be all right. I'm grossly simplifying, but it was. It wasn't all the different, interconnections, and of course we learned from that experience. We all learned from it, but this is okay. I'll stop there.
Axel, would you agree that everyone's prepared for the worst and can survive a shock like no deal Brexit on Monday?
Well, we have taken precaution exactly along the line that was the line I always use. We have to prepare for a worst case scenario and actually hope for a better outcome. Being a Swiss bank, we were under no illusion that whatever access we have from London to the European markets was a right granted and an access granted by the Europeans under an equivalent standard. It was not a right that you could basically rely on. And what we had to do, because London was our major operation in the European Union and Switzerland is not part of the European Union, we had to create the optionality. And I think that is really, Brexit planning is around having optionality, if and when it were to happen, that we would be able to have continuity of dealing with our clients and dealing with our book from a constituency that has market access as a granted right rather than as a commissioned favor. And so we basically on 1st of March, I signed our takeover agreement of UBS Frankfurt SE, taken over limited. We've carved out the UK business. We're prepared. Do I hope that we need to transfer on top of some organizational arrangements that we put in place, staff and operating systems? No, we don't. So we hope for an agreeable market access agreement between the UK financial institutions. In the view of banks, it's too much about trade. There's too little about financial infrastructure and financial services.
Yeah.
And of course, that is the key of where the concerns are. Trade is a slow-moving train. Financial services is a fast train. And therefore, you need to put in provisions, the first provision to get finance right, and then you can do everything else. Policy is negotiating this the wrong way around. They're too worried about trade. They're not, in my view, sufficiently focused on finance, and finance is an amplifier of any problem that will proliferate around the European financial sphere, if not sorted out. Mark and the Bank of England have done a great job to raise that awareness with everyone else, and so we think that is understood. But unfortunately, we're not quite there. We still need an agreement with the European Union that goes beyond 1 year. We have a 40-year-old 40-year derivative book out there. It doesn't help me if somebody says, you know, that's okay for 1 year. So what about the rest of the 34 years? Do I need to novate the book to Frankfurt? We need grandfathering rather than transition agreement. We need grandfathering of everything that was done under EU rule in the UK to stay in place as long as the date on that contract is.
Right.
And we haven't got that yet, so I'm still concerned.
Can I? I didn't answer the second part of your question.
What the probabilities of outcomes?
It was
Do
the
tell us your betting
no,
on
you didn't ask.
probability.
Well, you said if I'm a betting man, I'm not a betting man, so therefore. But you asked about longer term city, and the point I'd like to make is, because it goes back to architecture, which one of the challenges, and this goes from trade to financial services, is this this imbalance between global rules and democratic sovereignty and accountability. And it goes to a point which Switzerland's living through, and we live through vis-a-vis Europe, but then we live through perhaps more immediately positively and constructively vis-a-vis the United States, we being the UK, which is equivalence doing exactly the same thing, or is it accomplishing the same outcome? And I would suggest that if you look at the system, financial system going forward, projecting out 10, 20 years, and irrespective of which jurisdictions it is, vis-a-vis China, for example, the Chinese are not going to do exactly this. They're not going to regulate their system exactly the same way as the UK or Canada or the United States. Provided the bits that are open, they get to the same minimum levels of financial resilience, market integrity, that's fine. That's the way the system, at least as it's developing, designed by the FSB, and that's the spirit of it. And that's the spirit of that. Those are platforms where you can have freer trade and openness in financial services. And by the way, that's how you can have freer trade in services as well, because people are not going to cut and paste exactly the same rules. Now, in a microcosm, that's part of the discussion that is not the short-term day-to-day discussion around what happens tonight, next few days, but the longer-term one, which is really a fundamental architectural discussion.
Interesting. We have a few minutes for questions, not a lot of time. Anyone who has a question, raise your hands. I think we have some roving microphones. And it would be courteous but not compulsory to identify yourself. And please keep it very brief. You have shocked them all into silence.
Shocking.
Okay, well, if there are no questions, and it looks like there aren't any questions, everyone's quite happy about the outlook for Bretton Woods and Brexit and everything else. Fabulously been so reassuring, the three of you. Let me ask a slightly different... yeah. There's a microphone just coming around here.
So I'm Hilton Root, George Mason University. So my question is, do you look at indicators such as sales of U.S. Treasuries and who participates in these as indications of some potential financial instability in the works?
It's a good question. We looked at it. I'll tell you, we looked at it a lot more closely in 2008 and GSE flows, the extent you could tell. And you need a combination of market intelligence, which sometimes is intelligence and sometimes is just anecdote and hunch, and the official data to try to parse together who's doing what.
Isn't that a scenario that one might want to prepare for? I know that there's been a lot of murmuring among this audience about the impending potential issues emerging from that problem. They see trends that they are concerned about, and it would seem to me that would be part of a scenario.
I mean, the way I would answer it is that a series of stress testing scenarios, whether from the center or by private financial institutions to my left, quite often deal with very sharp so-called snapback risk. It can be motivated by a variety of things, weird moves in the curve, up or down, deflationary or inflationary, or because caused by market technicalities, but couple standard deviation moves in order to help stress the books of banks and so irrespective of the motivation of it.
We have a question over there. Yes.
Hi, I'm Paul Applegarth. Without a working mic, I guess.
If you speak,
Well, I can hear you. You've got a
Just
great
shout
voice.
out.
Now, I usually don't need a mic, I will say. Yeah, I'm coming back to this title of this session, which is the future financial structure, and I've been sitting here. First, it's been very good, very interesting, but I kept thinking something is missing, and I guess what's missing is other big players in that financial architecture now and going forward. There are no non-bank financial managers here who control a tremendous amount of assets, drive a lot of financial flows, the hedge funds, the arbitrage funds,
Yep.
so on. Are they here and I'm not aware of it, or should they be here, and how should they come in? How do you incorporate this into this structure, which
Right.
right now everybody here is a traditional institution? How do you incorporate them? Will they come in? Probably not.
Okay,
Maybe
so
I'm wrong,
are we all too 20th century?
Yeah. No, I think it's a great question, and I apologize if we sort of alluded to it but didn't head it straight on. So I made the reference that all the capital flows to emerging economies, on net, have been from market-based finance. So that's effectively the asset management complex, a bit of hedge fund thrown in on the top to as part of it. And one of the issues that is being looked at very intensively, both from the private sector risk managers, but also from the public sector, is that these, whether they're mutual funds, UCITS, whatever, they're buying relatively illiquid securities. Think emerging market corporate debt under any form of stress, some forms of leveraged loans, sometimes real estate, other illiquid securities, and they're offering daily liquidity to the underlying investors. Okay, that's interesting. What are their liquidity management policies? How much, what's their ability to manage that liquidity? What rules should there be there? And it is a very active discussion because it's a coordination issue as much as anything. If you run with higher liquidity, you've got a carrying cost and you're less competitive against others, even if you think it's the right thing to do. And it's a system that hasn't been stressed or hasn't been seriously stressed. And so this is a point I was trying to make earlier on, which is this is where it gets tougher because you're talking about a counterfactual,
right.
unlike in 2008, having seen banks go down and then you realize, okay, there's definitely not enough capital. Here there can be arguments that actually retail investors are very sticky and they have loss aversion. So, but this is a live issue. It's a live issue, which is, I think, pretty core to the
Well, I
risk
think
going
that
forward.
basically, we're sadly out of time now, but I think that basically cuts to very much the core of what the theme of the panel has been, which is that if you all agree that collaboration is not dead, in some ways it's needed more than ever before, not a very resounding vote of confidence that the Bretton Woods institutions will still be around in 75 years' time, but collaboration will be there. The question really is, how do you collaborate in a world where the balance of power is changing, where Asia, China is rising, where you're going to have currency realignment as a result, and when you have the old tribalism breaking down, and it's no longer just about the banks, it's also about the non-banks, and it's also about digital, which is not something which Bretton Woods institutions have dealt with at all. So it's a time of tremendous flux. So in many ways, it is absolutely a fascinating 75th year birthday. You don't just need a facelift, but you need a really quite radical bout of resurgery, if you like, for Bretton Woods. So I guess...
A makeover.
I guess I should just say, we'll finish by saying, thank you all very much indeed for your thoughts. Thank you for talking about Brexit, although I know you didn't want to. And best of luck to all of you in the room for figuring out how we have this 75-year-old creature get a real workable makeover. Thank you.
Thank you. Thanks.